I'm Phil Brendel. Tonight, my colleague Negisa and I, both of Bloomberg Intelligence, are thrilled to be kicking off the Beard Group's second Distressed Media Night with our interview with Jason Mudrick. Jason, welcome.
Thank you, Phil.
With this crowd, I'm sure no introduction is needed for Jason, but humor me a moment. Just as an outside observer, Jason, your career path strikes me as someone who does not waste time. You got your Bachelor of Arts from University of Chicago, your JD from Harvard 3 years later, and joined Contrarian Capital Management in 2001. And then after a short stint, and there you managed money, and by 2009 you launched your own firm, Mudrick Capital Management, which you continue to lead. So know that you're active in the corporate credit space, but perhaps you can just provide us a description of Mudrick Capital today and your target investment opportunity set.
Sure, and thanks everyone for being here. I participated in a lot of panels, but I'll tell you this is a first with the technology. And my mic keeps going in and out. You can hear me?
Yes.
I can hear you.
So thank you everyone for having me. So Mudrick Capital Management is an investment firm based right down the street. We have about 35 employees. Most of us sit here in Midtown Manhattan, but we also have a small office in London. We manage about $3 billion. In all we do is stressed and distressed credit. So we'll talk to you today about liability management. It's a core focus of ours. This is all I've done for 26 years, not liability management. That's newer technology, but distressed credit investing.
Yeah. And so one of the matters in which I witnessed your firm was Party City, the first Chapter 11. And there, an opposing group of four, Capital Research, Silver Point, Davidson Kempner, and Monarch Capital, held a dominating 90% of the first lien notes, had backstopped a $150 million dip with a 10% backstop fee. Classic case of stakeholders putting new money into a rescue company. But in this case, it was a good example of the self-serving nature sometimes is you're rescuing your own big stake in the company, and they were taking care of themselves. Long story short, your firm was the only one objecting to the $15 million fee and plan confirmation, where nearly the entire company went to the new money. And so I'm not going to relive Party City, but it was one of those opportunities for me to see that Mudrick Capital was no shrinking violet. And I guess a good place to start, as we're going to segue into LMEs, is how do you view employing litigation? Is it core to your strategy, or is it kind of a necessary evil?
I would say it's more of a necessary evil. Party City was, for those of you that follow this stuff, was a Judge Jones, the Southern District of Texas case. Jones is no longer on the bench, as everyone knows, but there was a lot of forum shopping back then in terms of how aggressive debtor plans would be. Does this work?
Yeah, take it a little bit further away.
How aggressive debtors could be with their plans, and Party City was on the very far end of the spectrum. So, look, when we feel like we're wronged, it's important to protect our rights, our clients' rights. I think this is an iterative game. We're in all of these deals, and I think it's important for people to know that we're not going to get steamrolled and that we will litigate. Interestingly, sometimes better lucky than good. That case was one of the aggressive uses of backstop economics, but the creditors there that had the majority had like 91% of the credit. So they were backstopping the entire facility, but they weren't really backstopping anything. And as everyone knows, in bankruptcy, you need to get paid reasonable compensation for services provided. They weren't really providing a service. We had told them, we owned another 7%, told them that we were going to participate. So they were really backstopping 2%, but taking a fee on the entire 100%, which, testing, which, was unreasonable. So I said better lucky than good. The backstop economics that they received was all post-reorg. Testing, there we go. Was all equity, and we ended up litigating and settling for cash compensation
That worked out well.
For about half of the value that we viewed that they had extracted from us. And as everyone knows, Party City ended up liquidating and the post-strike equity ended up zero. So sometimes better lucky than good. We recovered more getting screwed there than everybody else did doing the screwing.
Yeah. Fascinating. Negisa?
Yeah, so let's kind of expand more on the LMEs. You mentioned that that's a big focus. What characteristics do you think make certain investors particularly valuable in the space, maybe co-op specifically? Where do you think the edge comes from? I mean, everybody's looking at the same cases. The docs are what they are. What do you think makes a difference?
Well, look, liability management transactions are fairly common today, but it is newer technology and it's rapidly evolving. So I do think it's a very specialized skill set, knowing how to navigate these. Structuring around an ever-changing and fast-changing legal environment as loopholes are getting closed and new ones are getting opened. I would say it's difficult to participate in liability management as a tourist. You need to be a specialist. That's one. Two, size is important. The deals are more mainstream, and the percentage of them that are non-pro rata or that involve disparate treatment among similarly situated creditors is rarer than it used to be because the technology has evolved, defense mechanisms, the cases have worked their way through the system, and loopholes have been closed. But it's still the biggest risk in liability management, besides the credit selection, is that you're on the wrong side of a non-pro rata deal. And the best way to insulate yourselves from that is to be large, because you need to get to requisite lender consent. And the best way to do that is to focus on the largest lender. So if you're a $3 million CLO in a $2 billion capital structure and you need to get to 51%, nobody really cares. But if you have $200 million of a $2 billion capital structure, it would be challenging for them to exclude you from the LME, and they would certainly incur a lot of litigation risk.
So it sounds like you favor more concentration as opposed to diversification in the portfolios, somewhat.
Yeah, you can't be in LMEs and be small. You have to be large and you have to be sophisticated, and it helps to be a repeat player. The advisors are the same advisors, the same legal advisors, the same financial advisors, oftentimes a lot of the same creditors. So like I said earlier, it's an iterative game, and I think that helps if you're viewed as a constructive participant in these things, someone that leads the deals and not follows, someone that's creative around structuring, and again, someone that it's painful to not include.
So being in that large position, how do you think about maximizing the benefits of joining a co-op, is having this all-encompassing deals that you mentioned, but also preserving some ability to maximize your own economics? Is there ever a concern that maybe you're getting boxed in before the opportunity set is clear if you are organizing too early? Is there such a thing as organizing too early?
It depends on what you're trying to accomplish. If you're trying to accomplish a non-pro rata transaction, then cooperation agreements generally, aren't going to help you. You want to find a small group of lenders that control 51% and just work with that group. If the idea is to do a pro rata deal, cooperation agreements insulate you from sponsor on creditor violence. I mean, that's the primary reason you'd want to co-op up, is to lock arms and all join forces against the sponsor so they know they can't divide and conquer, offer one group a certain deal and another group a different deal. So.
Do you think the market has become or is becoming more collaborative among those repeat players?
Yeah, for sure. I mean, this technology is relatively new. I mean, liability management or similar type transactions have been around for a long time, but they were few and far between, like one a year, two a year. I think we did one of the first true LMEs back in 2013 in Not Your Daughter's Jeans, but it was like the only one that year. During the pandemic, there was a spike, and they've really become quite prevalent since interest rates started to normalize in 22. Okay, so what's happened is you had very aggressive transactions early on. It was sort of the wild, wild west, the J. Crews of the world, what we tried to do with Not Your Daughter's Jeans. And what's happened is, a number of things, but passive investors have gotten smarter, right? The legal franchises that help facilitate these deals have gotten smarter. So what ends up happening now is groups form earlier, and they're more inclusive. Okay, because the advisors want to be hired, so there's usually a story leaked in Debtwire or on Bloomberg or on Reorg Research, And now everybody knows you need to be in the group and not out the group. So every lender, including passive lenders, call up Gibson Dunn or call up Davis Polk or whoever is rumored to be organizing the firsts, and you want to get in the group. You want to get in every group because you don't want to be excluded. You also have cooperation agreements. Cooperation agreements have been around forever, but the use of them in transactions like this is a newer phenomenon. So you have these defense mechanisms evolve. And then you have loopholes being closed. You have cases being appealed and remanded back. And the law is changing. Like I said, the lawyers will always figure out new loopholes and new ways to effectuate these transactions. But it's less wild west. You're seeing more pro rata transactions. But non-pro rata transactions are still common. When we did a very aggressive non-pro rata transaction in Tropicana just last year, about a year ago. So they still happen, but they're less frequent.
Do you have a sense, as you've done many of these, what may be the telltale signs early on that an LME may be successful? And I mean, that obviously depends on how you define success, and maybe different for you than for the sponsor. But is credit cohesion part of it? Are you able to tell? How does the actual process work?
How are you defining success?
Well, I don't. I'm curious how you are defining. I know participants define it differently. That's why I'm curious how you start defining it.
Presumably, it's making money. So why is an LME successful if the goal is making money? There's two ways you can make money. You can get refinanced out. Right? Look, all an LME is effectively kicking the can down the road. Okay? It almost always involves a maturity extension. Sometimes it involves a liquidity injection. That's what the sponsor gets. They get more time and they get more money if they need it. And sometimes they'll get discount capture if the exchange is done at 90 cents or at 70 cents or something more aggressive. What lenders get is covenants. Okay. Sometimes there'll be backstop economics, a change in coupon or something like that, but usually what we're trying to do is solidify where we sit in the capital structure, and that's the quid pro quo. We live in a covenant-light world, and that's why you can effectuate LMEs, because there's no covenants, so you can make it particularly punitive to not participate in a deal out of court. Right? The reason LMEs can happen without covenants is you don't need bankruptcy. Traditionally, with covenants, you would need to go into bankruptcy court, get your 2/3 vote, and then you could force the other third into your deal. You have to do that in court because you need a court to tear up the contract. It's a court of equity, it's bankruptcy. Out of court, every lender has their contractual protections, so you have a holdout problem, right? Like if I mature next year and everybody else wants to extend for 2 years, why don't I just sit around and be the first maturity? Well, what LMEs allow you to do, because you don't have covenants, is you can make it so punitive for that person to not participate that they're better off participating. You can extract all the assets, dividend them out into an unrestricted subsidiary, and then let everybody that participates in the maturity extension exchange back into the collateral they thought they had. Right? So what we get when we do these LMEs is we put covenants back into the documents to make an LME 2.0 impossible or much more challenging. You move the lender thresholds, the requisite lender thresholds higher, you close the loopholes, you put CERTA protection, memento protection, J-Crew protection, et cetera, et cetera, et cetera. And then it gets back to distressed 101. Like distressed investing historically was valuing the business, putting the capital structure on the business, and then you say, well, this senior debt's covered, and this debt's the fulcrum, and this debt's out of the money, and you pick your risk tolerance. Problem today is you do that analysis, you value the business, which is hard enough because you're not valuing what it's worth today. You're valuing what it might be worth 3 to 5 years from now, post the restructuring. You layer on the capital structure, but then you wake up tomorrow and you thought you were creating the business for $1 billion, and it turns out you're creating it for $1.5 billion because they borrow $500 million from Angelo Gordon and slot it in senior to you, and your first lien debt is now second lien debt. Or you wake up and half the first lien debt is swapped senior to you, and now you're second or third lien debt. So that's, sorry, what was wrong with the question?
No, that's perfect. The question was about, what's successful.
So then you go back to distressed investing, and then the question is, what are you trying to accomplish? Are you trying to own the business, okay, or are you trying to get refinanced? And that's a very company-specific analysis. right? So we did an LME last year in Cox Media, and we thought Cox was solvent. They just needed more time. Okay, we gave them an extension, we gave them some more money. As soon as we announced the deal, took the risk of non-pro rata treatment out of the market, put covenants in the document, gave the company the financial flexibility and the time to address their capital structure, and the loan traded up 15 points. And with a year of coupon and the 15 points, we made 25% in a year and moved on. Never owned the business. Okay, compare and contrast that to another LME we did a year and a half ago, Incision. That post-LME debt is trading at 40 cents. Okay, the document's been tightened up, so the 40-cent analysis is the creation value. It's about $1 billion creation value. And we expect to own the business. That's a platinum equity-owned business. We don't think they'll ever be able to refinance, and we'll own it. We think we'll make much more money in Incision than we did in Cox, but it's going to take a lot longer, and we're going to own the business as opposed to just selling the debt in the secondary market when it traded from 80 to 95. So both made money. Each analysis is, what are you trying to accomplish? How will you make the most money? What's the best risk-adjusted approach to the investment?
No, it's a great point, because LMEs, when you think about success of an LME, it depends on your perspective. For a company, it's about staying alive, maximizing the enterprise value, and for a distressed investor, it's really about, I'm putting money in. What's my rate of return, and maintaining the flexibility that maybe I'll exit tomorrow. Maybe I'll exit 3 years from now. It's kind of fascinating, but I think it's something that everyone should be considering when they get involved in LMEs, or approving them or not approving them in court. One question. AMC was a name that you were really active in, and I'm really curious because I don't think it's fully appreciated, but their having a public equity really was a huge windfall for AMC and all the stakeholders there. And I'm curious, is that underestimated by the restructuring committee now that we're in this world of private equity, and we're just seeing companies not necessarily issuing public equity? And I'm curious what your thoughts are on that, because it's a nice avenue to have for financing.
Yeah. Look, I think what happened during post-COVID with the whole meme stock phenomena, the markets aren't going to forget that, and we see pockets of it, but I do think it was, for the most part, a moment in time. And the reason it worked for AMC was, usually when you have a publicly traded equity of an insolvent company, okay, so AMC's second lien debt was trading for 5 cents on the dollar. 5 cents, not 50, 5. This company was 2 weeks away from going bankrupt when we rescued them the first time. There was 4 transactions we did with AMC, the last of which was an LME, the first of which was a rescue financing. But they had an irrationally high equity value because it was beginning to become a meme stock, and then it became the poster child of meme stocks along with GameStop. At one point, AMC was being valued at a higher valuation than 60% of the S&P 500, and it was insolvent. And today, the equity value is de minimis, and that's after all the equitization that they did. So they issued a tremendous amount, billions of dollars of equity to pay back debt, and that created a situation that most of us had never seen. Could it happen again? Sure. I think it was mostly a moment in time. Most companies that are insolvent aren't going to have $50 billion market caps where you can issue $1 billion of equity in days to pay off debt.
One other aspect of that restructuring, and I'm curious if you can comment on, is you had a relationship with the management team there. And I'm curious, from a restructuring point of view, how important is that as an investor to have a direct relationship with the management teams, as opposed to a lot of times it's through advisors? And I'm curious what your thoughts are and the importance of that.
Well, it's a stylistic thing. We think it's very important. I think more than most distressed firms tend to get very close to management teams, but we're also a distress for influence, distress for control type strategy. So I've served on over 20 boards of directors and close to 100 creditors committees. It's an active style as opposed to a passive style. So again, I think it's a stylistic thing. Oftentimes when you get very close to management, you get restricted, so you have to have capital that can have longer lockup investments. But at the end of the day, it's harder in LMEs because most LMEs are private equity-owned businesses, and the sponsor usually tells the management team not to talk to creditors. AMC was a publicly traded company. They had an investor relations department. They had a CFO, so it was easier to get close to management and try and understand what their motivations were, which was important in AMC because what drove our initial investment there was a belief that management would do basically anything to avoid bankruptcy. And the only way you could really, usually these management teams, they want to avoid bankruptcy, but then they're looking at their long-term incentive plan. They realize it's underwater. They know that if there's a deleveraging event, the management will get a new long-term incentive plan that will be valuable, whereas their old one is invaluable. So at some point, everybody, usually the advisors that will make the most amount of money in the restructuring, everybody's telling them, you're better off putting this company in bankruptcy. And the board wants it in bankruptcy to cover themselves. So there's a lot of momentum once Kirkland & Ellis is hired and others to get these things into bankruptcy. And in AMC, you had a management team that desperately wanted to avoid bankruptcy for whatever reason. You would not have known that if you weren't close to the management team. So I think it helped us there. But oftentimes you don't have access. You have access through the normal channels of management presentations to creditors and financial advisors and conversations with the sponsor. And often management is sort of kept away from lenders until there's a point in time where they realize there's going to be a change in ownership. And then you see them flip. But that's not happening with LMEs. There's an extension of maturity. When there's a restructuring, at some point they sort of realize there's going to be new owners, and it's usually in their interest to befriend you.
One last question, maybe, if you have time.
I think we have more time than that.
Oh, okay. So I guess looking forward, I'm wondering what you think could have the largest impact in the LME space over the next few years.
Well, I think that I don't think the technology that people use to effectuate LMEs is going to be forgotten or go away. But I do think that the prevalence of LMEs is somewhat of a moment in time. It's not 1 year. It probably is a 5 to 7 year phenomenon. But all of these over-leveraged balance sheets, so most of the LME candidates are pre-2022 leveraged buyouts. Okay? So this was an environment where the market was comfortable with more leverage than they are today because the cost of debt was much lower. It was 50 basis points, 1%. Now it's 4 or 5%. You can afford less. So 6 turns debt to EBITDA was the norm before 22 at new issue, and now it's closer to 4. So you have a lot of impaired balance sheets that aren't refinanceable today. Okay, but you have public equity valuations that are still very high. Okay, so the sponsor is saying, hey, I can't refinance this today, but my equity's in the money. So I need more time. I need more time for rates to come down. I need more time to grow into the capital structure, to run an M&A process and sell the business for 12 times. So you're 6 turns levered, you can't refinance, but the business is worth more than 6. You don't have a solvency problem. You have a liquidity problem. You have a refinancing problem. So that's the dynamic that we're in today. And with the covenant-light nature of the loan market, most of these better quality businesses can orchestrate this extension one time. Okay. The problem is when you get to that new post-LME maturity wall, it's going to be much more challenging if we do our jobs right to do another LME. So at some point, all of these LMEs, all of these legacy LBOs that are going to get one extension are going to either file bankruptcy or they're going to get refinanced. And I think the biggest thing that's going to impact the LME world is the new maturity wall. Okay, not the maturity wall of pre-LMEs, because a lot of those will extend, but the post-LME maturity wall will look like traditional distressed investing. These companies will either file or they'll pay you back, and then there will be no more LMEs.
I want to get one last question, and I'm going to kind of do it as 2 questions, but I want to hear your outlook for what you think is going to be happening in the restructuring world, maybe for the next year. You probably have a good idea. But then also, from your experience here, like managing money in distressed space, do you have a rule of thumb that like you never cross? And this is something that someone might argue this is a great investment, but you're like, if it doesn't meet this, I'm not going to do it.
So your first question, the next year, I think we're in a world of LMEs. The economy is still robust. We'll see for how long. If we go into recession, I think there'll be a spike in defaults. There'll be more defaults. But as long as things stay as they are, I think most of the higher quality, bigger businesses are going to get extensions of maturity. And I think that if you look at our pipeline and what we've been working on, almost no debt for equity situations. Everything is an LME. We're working on Periton right now. Everything in the pipeline are situations that are pre-LME, post-LME, but not imminent default. So I think the default wave is a few years out, unless the economy changes. In terms of rule of thumb, I mean, there's a lot of there's no hard rule of thumb because you have to be opportunistic and there's always exceptions. But there's hard, expensive lessons that we've learned over the years that obviously guide our investment thinking. One of them is in distressed, small companies are challenging. Okay? I used to have an entire business investing where the oak trees didn't go because we were smaller and could be more nimble. These bankruptcies cost a lot of money today. When I started in the business, a bankruptcy would cost $2 or $3 million, and now it costs $30 to $50 million. So if you have a small cap company doing 20 million of EBITDA, like you can't restructure that. So a lot of the mistakes in our portfolio, they're not mistakes in that we've lost money, they're mistakes in that we can't exit them. And our holding period, which is supposed to be 3 years, turned out to be 10 years. So we try and avoid small cap. I think it's very challenging to do distressed in small cap. And we define small cap as anything less than $1 billion. So these are bigger businesses now.
That's great. Thank you so much, Jason.
My pleasure.
Thank you, Jason.